Most people will work 40 years, save diligently, sacrifice vacations, skip luxuries, and still retire with less monthly income than what a single well-constructed dividend portfolio can generate automatically every single month without them lifting a finger. That is not a motivational quote. That is math. And today you're going to understand exactly how it works. Here's the uncomfortable truth about money that schools never teach you. Trading time for dollars has a ceiling. There are only 24 hours in a day and your body will eventually stop. But a dividend portfolio, it never sleeps. It doesn't call in sick. It doesn't ask for a raise. In this video, you're going to learn what dividend investing actually is with real numbers, real case studies, and a step-by-step framework you can start building this week, even with a modest amount of capital. We'll cover the core mechanics, the most dangerous mistakes beginners make, a practical investment strategy, and a real-world case study of someone who built life-changing passive income starting from scratch. Stay until the end. The case study alone will change how you think about money forever. Let's start with first principles, because most people fundamentally misunderstand what a dividend is. A dividend is a company sharing a portion of its profits directly with shareholders, with you simply because you own a piece of that business. When a company like Johnson & Johnson or Coca-Cola generates billions in profit, a slice of that money flows directly into your brokerage account on a scheduled basis. Quarterly, monthly, automatically. Here's the scale of what we're talking about. According to S&P Dow Jones indices, S&P 500 companies paid out approximately $588 billion in dividends in 2023 alone. That money didn't go to executives. It didn't go to employees. It went to shareholders, people who simply own the stock. Now, the average dividend yield on the S&P 500 has historically hovered around 1.5% to 2%. But focused dividend strategies, targeting what are called high-yield or dividend growth stocks, can produce yields of 3%, 4%, 5%, and beyond. Let's put real numbers on this so it becomes tangible. If you build a dividend portfolio worth $500,000 at an average yield of 4%, you are generating $20,000 per year in passive income. That's $1,666 per month deposited into your account, whether you work that day or not, whether the market is up or down, whether you're on vacation or in the hospital. Scale that to $1 million at the same 4% yield, and you're looking at $40,000 per year, $3,333 per month in passive income. That is, for many people, enough to cover all essential living expenses without touching the principal investment itself. This is why legendary investor Warren Buffett, through his company Berkshire Hathaway, held approximately $6 billion in annual dividend income from its investment portfolio as of recent filings. Buffett has famously said, "If you don't find a way to make money while you sleep, you will work until you die." He wasn't speaking philosophically. He was describing his actual portfolio. But here's where it gets even more powerful, and this is the concept that separates wealth builders from everyone else: dividend reinvestment. When you take those dividend payments and automatically purchase more shares of the same stock, you trigger compound growth on your income stream. Your dividends buy more shares. Those shares generate more dividends. Those dividends buy even more shares. The cycle accelerates. This is not theory. According to data from Hartford Funds, dividend reinvestment accounted for approximately 69% of the total return of the S&P 500 from 1960 to 2022. Nearly 7 out of every $10 of wealth generated in the stock market over 6 decades came from dividends and their reinvestment, not from stock price appreciation alone. That statistic deserves to sit in your mind for a moment. Most retail investors obsess over stock price movement. The professionals obsess over dividend yield and dividend growth. Now you know why. Now let's talk about what kills most people's attempts at dividend investing, because getting this wrong doesn't just limit your returns, it can actively destroy your capital. Mistake number 1, chasing yield without understanding sustainability. This is the most common and most destructive error beginners make. They search for the highest dividend yield available, 10%, 12%, 15%, and assume more yield equals more passive income equals better results. Here's the brutal reality. An abnormally high dividend yield is often a warning signal, not an opportunity. When a company's stock price drops sharply due to deteriorating business fundamentals, the yield calculation inflates mechanically. If a stock pays $1 per share annually and the price falls from $20 to $10, the yield jumps from 5% to 10%. It looks attractive. But the price dropped because the business is struggling, and struggling businesses cut dividends. This is called a dividend trap, and it has wiped out the savings of countless retail investors. A documented example, General Electric, once one of the most beloved dividend stocks in America, cut its dividend from 96 cents per share to just 4 cents per share in 2018, a 96% cut. Investors who had piled in chasing the yield were devastated. The stock price had been declining for years, and the high yield was a flashing warning sign that most ignored. The metric you must understand is the payout ratio, the percentage of a company's earnings that it pays out as dividends. A sustainable payout ratio for most businesses is generally considered to be below 60%. Companies paying out 80%, 90%, or more of earnings in dividends are frequently living on borrowed time. Mistake number 2, ignoring dividend growth in favor of high current yield. Here is the counterintuitive truth that separates amateur dividend investors from strategic ones. A stock with a moderate current yield, but a strong history of dividend growth will often outperform a high-yield stock over a decade. Consider this. Johnson & Johnson has increased its dividend every single year for 61 consecutive years. Companies with this track record are formally called dividend kings, stocks that have raised their dividend for 50 or more consecutive years. The broader category, raising dividends for 25-plus consecutive years, are called dividend aristocrats. As of 2024, there are 67 dividend aristocrats in the S&P 500 index. Here's why dividend growth matters more than initial yield. If you purchased Coca-Cola stock in 1994 at roughly $5.28 per share, split adjusted, and held it through today, your dividend yield on that original cost basis would now be over 50%. Not on the current price, on what you originally paid. Meaning your annual dividend income would exceed half your original investment every single year. This is called a high yield on cost, and it's one of the most powerful long-term wealth mechanics in investing. Legendary investor Peter Lynch put it plainly, the person that turns over the most rocks wins the game. In dividend investing, that means doing the work to find companies with consistent, growing earnings and a disciplined history of rewarding shareholders. Mistake number 3, overconcentrating in one sector. Many beginners build a dividend portfolio that looks diversified but is actually sector concentrated. They load up on utilities or REITs or energy companies, all of which tend to have high yields, and believe they're spread across many stocks. During the 2020 COVID-19 pandemic, approximately 60 S&P 500 companies cut or suspended their dividends within a single quarter. Many of those were concentrated in real estate, energy, and consumer discretionary. Investors who held overly concentrated positions in those sectors saw their passive income evaporate almost overnight. True dividend diversification means spreading across multiple sectors: healthcare, consumer staples, technology, financials, industrials, utilities. When one sector is under stress, others continue performing. Mistake number 4, expecting immediate results and quitting too early. This is behavioral finance, and it's just as important as any metric. Dividend investing is fundamentally a long-duration strategy. The explosive compounding effects, the ones that build real wealth, take time to materialize. Most people underestimate what 10 years of consistent dividend reinvestment can produce, and they overestimate what 6 months can produce. Patience here is not a passive quality. It is an active competitive advantage. Every investor who panic sells a fundamentally sound dividend stock during a market correction is gifting their future passive income to whoever buys that stock at the discounted price. Now let's build this out practically. Here is a framework you can implement starting today. Step 1. Define your income target. Before you buy a single share, get clear on your number. How much monthly passive income are you trying to generate? Is it $500 per month to offset a bill? $2,000 per month to cover half your living expenses? $5,000 per month for full financial independence? Work backwards from your target. If you want $2,000 per month, $24,000 per year, and you're targeting an average portfolio yield of 4%, the math is straightforward. $24,000 divided by 0.04 equals $600,000 in invested capital required. That number may feel large right now, but knowing your target is the first act of building toward it. And in step 4, you'll see exactly how someone reached that number faster than most people believe is possible. Step 2, screen for quality dividend stocks using the right criteria. Here is a concrete 5-factor screening framework. Factor 1, dividend yield. target a range of 2.5% to 6%. Below 2.5% offers limited income. Above 6% warrants scrutiny of sustainability. Factor 2, payout ratio. Look for companies paying out below 65% of earnings as dividends. This leaves room for the business to invest in growth and to maintain dividends during economic downturns. Factor 3, dividend growth history. Prioritize companies with 10 or more consecutive years of dividend increases. This demonstrates financial discipline and business durability. Factor 4, earnings growth. A dividend can only grow as fast as the underlying business earns. Look for companies with consistent earnings per share growth over the past 5 years. Flat or declining earnings with rising dividends is an unsustainable trajectory. Factor 5, debt-to-equity ratio. Highly indebted companies are more likely to cut dividends during financial stress. Generally target a debt-to-equity ratio below 1 for most non-financial companies. Step 3, consider ETF-based dividend investing as a core foundation. If individual stock selection feels overwhelming, especially when you're starting, dividend-focused ETFs are an outstanding entry point. They provide instant diversification, professional index construction, and low management costs. 3 of the most commonly referenced dividend ETFs include Vanguard Dividend Appreciation ETF, VIG, focuses on companies with strong histories of dividend growth. Expense ratio of approximately 0.06%. As of early 2024, it holds approximately 315 stocks and has delivered average annual returns exceeding 10% over its lifespan. Schwab U.S. Dividend Equity ETF, SCHD, widely regarded as one of the best dividend-focused ETFs for income investors. It screens for quality factors including return on equity and dividend consistency. Expense ratio of approximately 0.06%, with a yield historically between 3.5% and 4%. iShares Select Dividend ETF, DVY, offers higher current yield exposure, typically in the range of 4% to 5%, with a focus on high dividend-paying domestic equities. Using a core and satellite approach, putting 60% to 70% of your dividend portfolio in one or two of these ETFs and building individual stock positions with the remaining allocation gives you both stability and the potential for enhanced returns. Step 4. Automate dividend reinvestment from day one. Every major brokerage, Fidelity, Schwab, Vanguard, and others, offers automatic dividend reinvestment programs, commonly called DRIP. Enable this feature immediately. Every dividend payment is used to purchase fractional additional shares, compounding your position without requiring any action from you. The mathematical impact of this is dramatic over time. According to data from Morningstar, an investor who reinvested all dividends in the S&P 500 from 1980 to 2022 would have turned a $10,000 initial investment into approximately $1.17 million. The same $10,000 without reinvestment grew to roughly $235,000. That's a difference of nearly $935,000 from the same initial investment over the same time period, driven entirely by reinvesting dividends. Step 5. Contribute consistently on a schedule. The investors who build meaningful dividend income are almost universally those who invest on a fixed schedule, monthly or bi-weekly, regardless of market conditions. This practice, called dollar-cost averaging, ensures you purchase more shares when prices are low and fewer when prices are high, reducing your average cost basis over time. Automate your contributions if possible. Set a fixed monthly amount, even if it's $200 or $300 to start. That flows into your dividend portfolio automatically. This removes emotion from the equation and ensures you're always building. Now let's look at a real-world documented example of someone who built meaningful dividend income from a modest starting point, because abstract strategies only become convincing when you see them applied in real life. The story of Bob Dawkins is one of the most well-documented examples in the dividend investing community, largely because Dawkins himself maintained a public dividend income journal for years that attracted tens of thousands of followers in the personal finance space. Dawkins was a mid-level corporate employee, not a Wall Street professional, not someone with a finance background. His financial journey was documented transparently, including his mistakes, his setbacks, and his milestones. He began serious dividend investing in his early 40s, not his 20s or 30s, which is a critical point for anyone who thinks they've started too late. His initial capital was modest by any standard. He was not investing hundreds of thousands of dollars from the start. His strategy was methodical and largely unglamorous. He focused on dividend aristocrats and high-quality REITs, real estate investment trusts, which by law must pay out at least 90% of their taxable income as dividends. REITs allowed him to capture higher yields while maintaining exposure to real estate cash flows without owning physical property. He invested consistently, every single month, without exception. During the 2008 financial crisis, when markets collapsed and many investors fled equities entirely, Dawkins continued purchasing. Some of his most valuable shares were acquired during that downturn, when quality dividend stocks were trading at deeply discounted prices and yields were inflated. He often described this period as the greatest wealth-building opportunity of his investing life. By reinvesting all dividends and continuing monthly contributions across a disciplined 12 to 15-year period, his portfolio reached the point of generating over $43,000 in annual dividend income, approximately $3,580 per month, without touching principal. What's instructive is not the final number. What's instructive is the mechanism. His wealth was not built by finding a secret stock or timing the market or making speculative bets. It was built through 1. Selecting quality companies with sustainable dividend histories. 2. Reinvesting every dollar of dividend income. 3. Contributing consistently on a monthly basis regardless of market noise. 4. Holding through downturns and viewing declines as purchasing opportunities rather than disasters. This is not an unusual outcome for someone who executes this strategy consistently over a long enough time horizon. It is actually a predictable outcome, predictable because it is built on mathematical compounding, not speculation. Consider this breakdown of how his income stream grew over time. In his first year, his annual dividend income was under $1,000. By year 5, it had grown to approximately $7,200 per year. By year 10, reinvestment and additional contributions had driven that figure past $22,000 annually. And by year 13 to 15, the compounding effect had pushed it to the $43,000 level. The growth wasn't linear. It was exponential, slow at the beginning, dramatically accelerating in the later years. This is the compounding curve that most people never experience because they give up in the early, seemingly unrewarding stages. This brings up what is perhaps the most important strategic insight in all of dividend investing. The wealth is built in the years that feel like nothing is happening. During those early years when your dividends amount to $80 a month, the temptation to abandon the strategy is enormous. The investors who resist that temptation and maintain their system are the ones who eventually find themselves on the right side of the compounding curve, where $80 a month becomes $800, then $2,000, then $3,500 and beyond. One additional dimension of the Dawkins case worth understanding: his dividend income was largely tax-advantaged. Qualified dividends from most U.S. companies are taxed at the long-term capital gains rate, 0%, 15%, or 20% depending on your income bracket, rather than as ordinary income. For investors in the 0% qualified dividend bracket, which applies to single filers earning below approximately $47,025 in 2024, dividend income is received completely tax-free at the federal level. This is one of the most underappreciated tax advantages available to ordinary investors. The lesson of this case study is not that you need to replicate every decision Dawkins made. The lesson is that the strategy is replicable, it is accessible, and it works not because of luck or market timing, but because of compound math applied consistently over time. Here's the reality: the information in this video works, but information without action doesn't build wealth, it just builds awareness. The investors who will be generating meaningful passive income 5 years from now are the ones who take the first step today. Not next month, not when the market feels safer. Today. If this framework helped clarify your path to financial independence, there's one simple action that costs you nothing and ensures you don't miss the content that continues to build on these foundations. Subscribe to WealthLogic and hit the notification bell. Every week, this channel produces data-driven, strategy-focused financial content built for people who are serious about building wealth. No hype, no shortcuts, just the systems and strategies that actually work, backed by evidence, not theory. Your financial future is being constructed right now, one decision at a time. Make sure you have the right information to construct it well. Let's close with the most important mindset shift you can make after watching this. Most people think of money as something they earn. The wealthy think of money as something they deploy, capital they put to work so it generates more capital permanently without their direct labor. The gap between those two mindsets is the gap between financial stress and financial freedom. It is not primarily a gap in income. It is a gap in understanding. The dividend investor who starts today with $300 a month and reinvests every payment is building a money machine. Quietly. Automatically, regardless of what the market does on any given day. In 10 years, that machine will be generating income that shows up in their account whether they show up to work or not. That is what financial independence actually looks like. Not a lottery ticket, not a viral trade. A machine built methodically, brick by brick, month after month. Your only job now is to start building yours. The best time to plant a tree was 20 years ago. The second best time is today. Start now. The math is already on your side. 1. Passive income from dividend investing. 2. Dividend investing for beginners. 3. How to build passive income. 4. Dividend stocks for beginners. 5. Personal finance. 6. Investing for beginners 2026. 7. Wealth building strategies. 8. Financial freedom. 9. Passive income investments. 10. Dividend portfolio strategy. 11. How to invest in dividends. 12. Beginner investment portfolio. 13. Financial independence, retire early. 14. Best dividend ETFs. 15. Stock market investing description. Build passive income with dividends. The beginner's blueprint money bag. Did you know dividend reinvestment accounted for nearly 69% of the S&P 500's total return from 1962 to 2022? Most beginners focus on the wrong things, and it costs them a fortune. In this video, WealthLogic breaks down exactly how to build real passive income from dividend investing, step by step, starting from scratch. We cover the core mechanics of dividend investing,